This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
All right, today we're going to take a look at the rental market's chances amid a potential recession.
Plus, is heavy truck production poised for a downshift in 2023?
But first, the big banks get all the sexy headlines, but really it's the regional banks and their earnings that you really want to pay attention to, because that's a true read into the consumer and how the economy is doing. Fourth quarter earnings results highlight what we might expect. Revenue growth is slowing, and there's decelerating margin expansion. Joining us for more is Herman Chan, Bloomberg Intelligence Senior Regional Banks Analyst. Herman, thanks for being here.
Thanks for having me.
So your broad stroke takeaways on a macro level for these guys, what are they telling us?
Sure. So what fourth quarter earnings and more importantly 2023 guidance is indicating is that revenue growth is slowing for the regional banking space. And that's really a function of where we are in the current interest rate cycle. So last year in 2022, when the rate cycle was really raging, banks benefited from higher interest rates because your loans reprice really quickly, but the offset to that is deposit costs. And those costs rise a bit more gradually. So the margins that the banks have generated over the last year has really expanded by a tune of about 65 basis points. So that may not seem like a lot, but if you're talking about an earning asset base of $150 billion, you're talking about higher revenues of a typical bank of the companies that I cover of almost $1 billion in pickup in revenue. So that's a pretty big deal. That revenue growth is going to slow going forward as deposit costs rise. And you can see that from a consumer standpoint, if you go and look at your potential high interest rate savings account, you're getting almost north of 3%, 4% for high yield savings these days. So those are the costs that the banks are paying out to your customers, and that really squeezes margins.
So give me the banks that can weather this the best and the ones that are going to be hit the most.
Sure. So the banks that have really stable funding costs, and that really is reflective of a more consumer orientation. So a retail customer's typical checking account is not seeing the same pickup in deposit repricing as you would see from a large corporate customer. So a bank like Regions Financial in the Southeast that operates in smaller demographics really should fare well because their funding costs should be much more stable versus others that maybe have a more corporate orientation on their deposit side or focus more on high wealth customers on the consumer side that are more rate and yield sensitive. On the other side, some of the banks are already seeing margin compression. Banks like SVB, Silicon Valley Bank, Signature Bank based in New York are already seeing margin compression because of higher funding costs.
Credit quality, if we got a recession here, do we have loan problems?
Yeah, I think the regional banks are actually pretty well positioned. If we get a shallow recession, I think the banks are already very well. They're well capitalized. Their asset quality is not showing any signs of early stages of a deterioration, and they've have really strong coverage on their loans in terms of their provisioning. So these banks have really changed drastically since the financial crisis. On the consumer side, they focus on prime, super prime customers. On the commercial side, they've exited a lot of the problem areas that affected the banking industry during the financial crisis. So less construction lending, less commercial real estate lending. And so they should be very well positioned to withstand any sort of recessionary scenario that could come through.
All right, Herman, love it. Thank you so much. We love your analysis always. Herman Chan, Bloomberg Intelligence Senior Regional Banks Analyst.
All right, let's turn now to the junk space, as investors' views have moved more positive for high-yield prospects. For more on this, we're joined by Bloomberg Intelligence Chief European Credit Strategist Mahesh Bhimalingam. Mahesh, thanks so much for joining us here. Brutal 2022 for fixed income investors. How are things so far this year, and what's the outlook?
Yes, it was a pretty terrible 2022. Next only to crisis like, the 2008-2009 or the Eurozone crisis here in Europe. How is it going now? It's turned in the fourth quarter itself. There has been a 3.5-month rally. Mm-hmm. So we've had a very strong January in credit in general, particularly in high yield. So it's been a very good start to 2023.
So can that continue? I mean, have we priced in like all the good news, or are there certain areas that you think might have more upside?
Right. So, just to link the survey because of which we are having this call, if you look at investor opinion, investors still have a lot of cash. So it went to record cash as they stayed away from risk in the fourth quarter, but they put some cash to use, but they are very positive on prospects in the first quarter, but also they do believe that valuations are rich. Our own view, we have a published view that, high yield will be generating about 5% returns, but some 2.5-3% has been realized already. So given the 3.5 months rally, we have a measure of normalized spreads. It is about one standard deviations rich now. So it definitely looks expensive. We could get a, retreat anytime. It's very difficult to predict when, but spreads are ripe for a retreat.
Mahesh, I'm sure you've probably heard there's a few economists out there saying that if we're not in a recession now, we very well likely will be in 2023. How do you think about credit risk in the high yield space these days? It was such a difficult time back in that great financial crisis, but how do you think about credit quality?
Very good question. So if you look at credit quality, there are 2-3 ways of looking at it. First is actual ratings. Second is defaults. Given that we are talking about high yield. So first thing, credit quality. Credit quality in investment grade, shockingly, is still improving, right? So the number of upgrades to downgrades is double. So which means overall credit quality is still improving. In high yield, that is not the case. In high yield, there are about 4 downgrades to every 3 upgrades. So the upgrade-downgrade ratio is about 0.75. So quality is deteriorating in high yield. That said, for the last 22 months, there has not been an index default. So the running 12-month default rate is still 0.
That can't last.
Yeah, that can't last. Yeah. Very good question. Now, what are we pricing in? So if you look at the markets, by October, we were at about 30% stress and about 5% distress. That has really come down now. So the stress is only about 15 and the distress is 2.5-3%. So I do believe that in 2023, my view, index default rate will not cross 1%. Now, for perspective, peak pandemic, when stuff shut down and we thought that a lot of dominoes will fall, what was the peak index default rate? 1%. Sorry, 1.8%. So which is why I believe that 2023, you'll probably have 1% and will peak at around 1.6% in 2024.
So if we're going to be looking forward then, how much money flow do you think is possible? Because whenever we talk about, say, TINA, there is no alternative. And that was when you had to buy equities. And that was specifically really equities in the U.S. Now it's Terra. There are reasonable alternatives to returns and the risk that you take in the equity market. How does European credit play a role in that?
It is no longer TINA now. So
it's definitely Terra.
Yeah. So underlying plain vanilla rates, they pay a lot now to start with. And investment grade pays a lot. So if you want to get into junk, you will need to be paid a reasonable premium. It still does pay, by the way. Junk yields are in Europe, for example, are at 7.1%. The Bund pays you only if you're lucky. It pays you about 1.6 whatever percent. So investment grade pays you 3.5. So there is a premium, but sophisticated investors might be thinking, do I go into junk or do I lever up investment grade, or even better, lever up rates, because it's easy to lever them up, right? Do I take leverage in the instrument or do I take leverage in the company? That's the choice. I'm thinking probably with investment grade paying like 3.5-4%, you're probably better off in levering investment grade. And that has come through in the survey. Investment grade is still reasonably favored even by high yield investors, because you're not going to get any defaults there. Quality is very good, it's improved, and even in high yield, people are sticking to double Bs. They're not going down to single B and triple C.
We're going to leave it there, but thank you so much. I really appreciate it. Mahesh Bhimalingam joining us, a Bloomberg Intelligence Chief European Credit Strategist.
Coming up on the program, we'll discuss the rental market's chances amid a potential recession.
We are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BIGO on the terminal. I'm Alix.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Despite concerns about the U.S. economic and construction outlook, the rental market may hold up better this time around than in past recessions. Joining us now to discuss this is Bloomberg Intelligence senior machinery analyst Karen Ubelhart. So, Karen, if I want to go out and get a piece of earth-moving equipment, I can actually rent it?
He's asking for a friend, by the way.
Asking for a friend, yes.
A lot of contractors now rent equipment. In the past, they owned the majority of their, particularly large contractors, the majority of their fleet. In the last decade or so, rental has been increasing. The rental penetration is about 58% in the U.S., and it continues to go up. But the story here is really there's so much money chasing so much construction activity, and the rental guys are going to do much better than they've done in past construction downturns.
I thought that this was going to be like a terrible housing market. Like, where's the disconnect?
Okay, housing is only 5% of the large rental companies' sales. It's much more of a non-residential business, essentially, and industrial construction as well. So you've got $1.1 trillion in government money over 6 to 7 years from the three big bills that the Biden administration put through. That money's just beginning to flow.
You're on the Inflation Reduction Act primarily?
The Infrastructure Act, the Inflation Reduction Act, and to a lesser degree the CHIPS Act. All of them require construction spending and therefore rental equipment. Also, they're large projects which tend to favor the large equipment companies as well.
I don't know, if I'm building a big project, what's my decision really between buying trucks and equipment versus leasing it?
A lot of times the construction equipment, since it's project-driven, will sit idle for long periods of time. So by renting it, you only pay for when you're using it. And so, you have higher utilization rates as opposed to spending, $100,000 on a large piece of equipment and having it sit there half the time. So that's the economics work toward renting.
The point is, though, if we have a downturn, whether you're renting or you're buying, whichever, you don't think it's going to be as bad. Is that like a pandemic overhang thing, or are we at like a different kind of cyclical place in this industry?
It's really the $1 trillion of federal money.
So it's purely government support.
And it's onshoring. There's a lot of projects as companies are building more capacity here. It's EV capacity being built. It's secular changes, things like that. It's really, I call it an embarrassment of riches. A lot of things are coming together at once for the rental sector. And in this industry, the big three dominate. And they've been growing 2 to 3 times the industry growth rate for a long period of time. And that should accelerate because there's only a handful of rental companies that can do these big projects.
When I think about the rental market, now they got me thinking, I'm thinking that must be a lot of mom and pop rental things out there. Is this an industry that needs some consolidation maybe?
Yeah, it's very fragmented. And, the big three are about high 20s now.
And who are they now?
Share.
Who are the big
The big three is United Rental is number 1, Ashted is the number 2, and Herc Rentals is number 3. The rest is small and mid-size.
So do the small and mid-size pair up, or do you think that the three big get bigger?
The big three have been buying up and they have different strategies. United Rental tends to buy bigger companies, and they do fewer deals but much larger. Ashtead might do 20, 30 deals a year, but they're pretty small, much less than $100 million. But over time, their share has grown up as the bigger guys gobble up the little guys. And HRI has not been in a position to buy, and they have been in the last year or so. They've started to buy up real small mom and pops as well. The small guys can't compete with all the technology required, with the capital commitment required. So this whole rental penetration is accelerating as a result of that. In Europe and Japan, rental is 65 to 75% of the market. In the U.S., it's like 57%. We're way off other mature markets, so there's a lot of upside.
Yeah, I'm looking at just United Rentals. A couple things jump out at me. It's a big company, more than $30 billion market cap, but the stock's done really well. And on trailing 12 months, it's up about 40%. Yeah. Is that primarily, hey, this is just a dumb infrastructure play for me?
Well, I think that people are finally realizing. Remember, infrastructure bill came out, 2 years ago, yep. and the money hasn't started to flow. It's starting to flow now, and the backlogs keep building for these guys. So I think the realization, last year actually they underperformed other industrials, such as the big equipment companies like Cat and Deere. This year, the light went off, I think, on how much business, pent-up demand there is for these guys, and that it's sustainable for multi-years. It's not just 2023. This is going to go on for a while. So that's what's changed.
What makes me worried, though, and I appreciate that onshoring may be a different thing than the infrastructure bill and the IRA, but when you're dependent on government money and you get a change in D.C. and then the money can just stop, even if it's law, you can still be directed to stop the flow of money. How much do you think that that's priced in and that is at risk?
I think particularly the infrastructure bill, which is in itself $600 billion, that money's well underway, and we won't have an administration change, right, for at least for 2 years, right? Mm-hmm. And right now we have a split Congress, so the money's they're not going to be able to. The obstacles are not going to be there to stop this money flow.
So we're talking about the big equipment rental business, but folks who actually manufacture these things, the Caterpillars, the Deeres, and all the rest. I know Chris Ciolino covers them for BI, but let's be honest, you've been covering these things for decades. Nobody knows this stuff better than you. So, are Caterpillar and Deere and all the rest of the folks that make this huge equipment, are they just running at full tilt?
Yes. There's actually a shortage of equipment, and that's another thing that helps. They cannot build the equipment fast enough, and you can look at those stocks. They've done really great as well, right? They would build more if they could. Mm-hmm. They don't have the capacity, and this is another disadvantage for the small rental guys. They can't get equipment. Guess who gets to the front of the line? Yeah. United Rental, Ashtead, the big guys, right? But Cat and Deere and CNH, et cetera, they can't. They have huge backlogs, and they're running full tilt, which is also why those stocks are doing so well.
Margins? I can appreciate the small and mid-sized guys are bigger than the big ones, but talk me through the margin story.
This is a volume. Rental is a very capital-intensive industry. Mm-hmm. About 80% of the money they spend is on equipment, right? So it's very volume sensitive. And in the last quarter, United Rental had 50% EBITDA margins, which is was a record, and the others are similarly in the high 40s. So it's very volume driven. Also, because equipment is so tight, the rental rates are very robust as well. So they have a volume pop, a pricing pop, right? That's what rates are, and being capital intensive, the incremental margins are very, very high.
So if I go onto a United Rental lot and I need a backhoe, am I paying full freight? There's no deal in here, is there?
No, and rates have been extremely high now for almost 2 years, and they're showing no signs of slowing. So you're lucky if you can get the equipment. That's the thing. It's really, really tight out there. So if we had a major recession, would some of the industrial business slow down? Yes, but there's enough money here just from the federal bills to carry us through a slow 23.
Yeah, this is a really bullish picture. I'm trying to find all the things that could worry you, but you're kind of chill about it. Is there something? Is there a bear case?
I've been through a lot of downturns in the rental companies, and they used to have their cash flow, was extremely volatile. Their earnings were extremely volatile because the volume would dry up in a recession, right, when construction would go down. But if you're looking at the trends, this time, housing is down, yes. the non-residential business is expected to grow this year, and that doesn't even build in all the public money. That's the non-res, the private money. Yeah. And the other thing I should say, I didn't mention, this is a North American play. So we don't have to worry about Europe. We don't have to worry about Asia. These guys are all North America.
That's a great point.
So,
all right, Karen, great stuff as always. Karen Ubelhardt, she covers all this machinery stuff, all the big equipment stuff for Bloomberg Intelligence, and nobody does it better.
She's the best. All right, coming up in the program, is heavy truck production now set to drop this year?
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide.
So if the U.S. economy rolls over a bit, whether or not we're in a recession or a slowdown, finding out what that means for different industries is going to be significant to making money. So let's take a look at the heavy truck sector and what that winds up meaning then for 2023 in the coming months. We're joined now by Bloomberg Intelligence industrials analyst Chris Ciolino. Chris, heavy truck production, what does that mean? Like, what is that? Is that like moving coal along a road? Is that what that is? Walk us through that.
Yeah, I mean, ultimately, the reason you buy a truck is to move freight. So everything from consumer goods to industrial goods, as well as commodities. If you look at the heavy truck market in the U.S. here, typically it ends up being more driven by industrial manufacturing type goods, but the consumer undoubtedly is an important part of that as well.
So, Chris, I mean, everybody's talking about a recession, and that can't be good if I'm making these huge trucks here. Just give us a sense of the sensitivity to the heavy truck business, manufacturing business, to kind of GDP.
It's very sensitive. This is a market that's very short cycle and very sensitive to economic growth. Like I said, I mean, the reason you buy a truck is to move freight. If the economy is not growing, freight tonnage is down, and you are looking to push out any kind of purchases of vehicles. And we've gone back and looked. Over the last 30 years, in these kind of low GDP type growth years, something with GDP growth below 2%, we typically see truck production decline 9% on average. And when we enter into recession years, truck production typically falls 30 to 40%.
Oh, wow.
So it is very sensitive to economic growth. And right now, consensus expectations for this year is for GDP to be up 0.5%.
Okay, so this could hurt. What companies are we talking about? And has their stock already priced something like this in?
So interesting. It's a very consolidated market. If you think about the heavy truck market in the U.S., there's really only 4 players that comprise like 90% of the market. Daimler, which has the Freightliner brand, which is the market leader. There's also PACCAR, Volvo, and Navistar. Now, Navistar was recently bought out by Traton, which is the VW truck spinoff, but those 4 companies comprise the majority of the marketplace.
How about the used truck business? Because I'm seeing stories about the used car business just really tanking after just, really skyrocketing during the pandemic. How about the used truck biz?
So used trucks, it's interesting. This is a market that was, red hot last year, basically because there was no inventory out there. All the supply challenges that we had at the manufacturing side, fleets couldn't get trucks. So they turned to the used market and basically depleted any inventory that was out there. We were seeing used trucks go for, more than double what they would historically go for. So astronomically high values. The market has inflected. If you look over particularly the last 6 months, used values have come down, and even the last couple months we've turned negative. I suspect we're headed even lower, really for the balance of this year. And why that's important is because, most new purchases do involve a trade-in of an older vehicle, so used values are a good leading indicator, and it really helps kind of reduce the purchase price when you go to buy a new truck. So as used values fall, we think that, portends to more of a bearish outlook for this year.
This is really grim. Does this lead the economy? Does the economy lead these numbers? Like if sales bottom, for example, or production bottoms, like is that a good thing eventually for everything else?
Yeah, it's interesting now because production continues to move higher, and a lot of that has just been a reflection of the supply chain loosening up. So we're seeing build rates the highest they've been since pre-pandemic levels, and orders are quite good right now. The backlog is healthy. That being said, this is a market, like I said, that turns quickly, and the backlog could evaporate quickly. So I think what we're watching now moving forward is some of the order rates. We think we're kind of close to peak production levels. We think OEMs are just going to be a little bit more cautious about booking orders too far out into the year, just given some of the macro uncertainty. And then also, we're still having challenges on the price cost front, so they don't want to get caught upside down on pricing.
So how about the supply chain issue? Because your industry, the truck manufacturing, was definitely one of those industries that felt the pinch. Are they now back to building trucks on a reasonable schedule?
They are, and it's very recent. I would say just really within the last 3 months, we've seen this normalization within the supply chain. We're not 100% back to normal, but we're pretty darn close. And we've seen sequential step up in build rates here through the fourth quarter, which is encouraging. But, at the same time, we're seeing all the leading indicators deteriorate and continue to deteriorate here in 2023, whether it's the freight markets, whether it's the macro indicators like ISM or industrial production or used equipment. So it's a little bit confounding right now because build rates are going up, but we have this kind of storm brewing on the horizon.
So, okay, does it also matter what these trucks move? Like if you're moving coal versus consumer goods versus something else, like is there a nuanced view in there?
A lot of the heavier commodities tend to go more rail. When you think heavy trucks, it tends to be more, industrial type products or consumer goods, especially for like the long haul heavy truck market. So those are kind of the markets we'll watch a little bit more closely as opposed to some of the more commodity ag or coal markets, which lend itself more to the rail network.
So, Chris, if I want to go buy an 18-wheeler, I go onto the lot. Can I haggle with my sales guy, or is he saying, no, it's a seller's market?
No, you're going to be paying a pretty penny just because still, while used values have come down, the inventory situation is still pretty tight, and there's just not a lot of used equipment out there. And the equipment that's out there is quite old and has a lot of mileage on it.
Before we let you go, I just want to get your take on drivers. How's the labor situation, and how does that feed into margins for these guys?
Labor is always an issue with the truck market. It's always difficult to find drivers. So it's always a challenge to attract and retain drivers. We have seen wages move higher, especially through last year. If you look, freight rates, were at, historically high levels. That has started to come down pretty precipitously. And one way to help, attract and retain drivers is through a new truck, but they're not able to get their hands on as much as equipment as they would have liked.
Chris, thanks a lot. Really appreciate it. Bloomberg Intelligence Industrials analyst Chris Ciolino. All right, let's turn now to the box sector. At least if the trucking section didn't, bum you out. Let's go to the box one. Packaging Corporation of America's fourth quarter results and first quarter outlook, along with all the industry data, is really painting a dire picture of the packaging demand. So for more on what this means for the industry, I want to welcome Bloomberg Intelligence Senior Basic Materials Analyst Richard Bourke. We were just talking to Chris Ciolino, who was really grim on the trucking sector. Are you going to make me feel better?
Well, with trucking down, that may help the box people deliver their boxes a little cheaper.
Okay. So maybe a little bit of margin of happiness. But overall, what does demand actually wind up looking like?
Well, demand's actually down record levels the last 2 quarters. And basically what's happened, if we kind of back up to the backdrop of what happened during the pandemic, everybody was stuck at home. They couldn't spend on restaurants. They couldn't spend on airline tickets, go to hotels. So what they do? They shifted spending on goods. In order to get those goods to your houses, you need them delivered. What did they come in? They came in boxes. So demand just took off, and the producers had a hard time keeping up with that. So what happens is if you're a retail person making, say, the Peloton bike for people want at home to exercise during that period, they need a box to ship it to you. And the last thing you want when you were told, well, we can't get you the number of boxes that you want, the next time you go to order boxes, you probably double your order. So we had a lot of over-ordering in the system, a lot of inventory at retail. And when retail sales started falling off probably the middle of last year as consumers, now pandemic ended, what do I want to do? Instead of spending on goods, I'm going to go to restaurants, I'm going to start traveling. The retail chain slowed down. They had too many boxes to start with, and their sales are dropping, and we're starting to see the effect of that. This huge destocking working through the industry.
Talk to me about the cost side of the equation. What is the cost of a box, like trees and paper and glue? And just tell me about how a box is made and kind of where the margin pressure might be coming from.
Well, there's two types of boxes being made. One are virgin from trees.
Okay.
And the other one is what's called OCC, old corrugated container.
Recycled stuff.
Recycled boxes.
Yep, okay.
In fact, the box industry, one of the good things about the industry, and it is helping demand, is they're probably one of the most sustainable industries there is, because they have such a huge recycle component of boxes.
See,
So,
I recycle my boxes.
right.
We're very good about that.
We haven't seen so much pressure in that. Where you're really starting to see pressure, and we're going to see more coming up this year, is kind of labor and benefits. A lot of the contracts that got renegotiated this year are going to start stepping up in 23. So we're going to see that. I think Chris before me talked a little bit about freight. Freight came off a record year, and now that's starting to look a little favorable for them. But there's still the other things are chemicals, starches and glue and things like that to hold the boxes together. Those still haven't come off the highs.
So is this kind of margin compression priced into the stocks?
It's not quite yet, because what's happening is everybody thinks there's going to be a soft landing, and you're kind of looking forward through the cycle and things like that. So we haven't really seen stocks compress that much, their multiples compress that much going forward, as people are just kind of, I think, digesting this news. Third quarter was bad. The big disconcerting thing is each month it got worse as the year went. In the fourth quarter, October was bad, November was worse, December was worse. So the question is, do we start to see a pullback in January, things like that? But people are kind of looking through, with the Fed, people are kind of looking through that maybe the worst is behind us. So,
Rich, if I'm invested in this corrugated box industry, and it was a big play on e-commerce and all that kind of stuff, now I'm just kind of back to some kind of GDP kind of business. What's really the play? If I'm an investor, what am I really investing in here?
Well, historically, it's been 1 to 2% growth. It jumped up the last 2 years. In 20 and 21, it was 3.5 and 2.5 respectively. With the demand being so high, one of the things they had to do in order to satisfy their customers is they did do a lot of premium shipping, premium freight, where we paid up to get boxes to where they ended up at be. So maybe as things normalize more, they can optimize their mill system, run plants a little more efficiency and things like that.
Where are the mills? Are they in the southeast U.S.?
Southeast, pretty much. Also in northwest.
Okay.
Correct.
How quickly do you think they're going to be able to just sort of, because this feels like it's a cyclical industry that also really got disrupted by the pandemic, for better and for worse.
Positively.
Right? Yeah,
Correct.
for the better and then now for worse. How long do you think it's going to take to refix it in terms of like shedding the pandemic stuff and getting back to a normal cyclical industry?
I think with the downturn that's happening we saw it in the fourth quarter, and we're probably going to see continue in the first quarter, I think it will refocus management's attention to actually do the fixes rather than run that.
Which is a good thing longer term.
Longer term. The one thing that Paul mentioned I thought was very interesting, e-commerce. When you did get something before, a year or two ago, it was coming in a big, huge box. Now it's coming into these little craft mailers or these little plastic. Amazon trying to move away from plastic, so that's good point here. But now before, where I ordered something, people used to complain, hey, I ordered a toothbrush, I got it came in a 2-foot box. Now it's coming in a little craft mailer and things like that. Now they do make those also, But obviously, it's not as big a margin project as the bigger box.
Richard, thanks a lot. We really appreciate it. Interesting conversation. Richard Bourke, a senior analyst over at Bloomberg Intelligence for Basic Materials.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.